For the panel, can we bank on banks? Which is a glorious play on words. It's almost a rap, isn't it? I'm Faisal Islam. I'm a TV journalist from the UK. We have a spectacular panel for your post-lunch digestion, who range from academia to social banking to government, all sorts of expertise. And we're going to get stuck into an issue that's obviously dominated news coverage for years now, even as we seem to approach a kind of more of a calm, apparent calm in the storm. But I'm sure we'll discover that calm is merely something of an illusion. We have a series of great speakers, but also we have new technology that I really want you to try and engage with. You should have on your smartphones, iPads and other devices this thing called Wissembly. Does everyone have Wissembly? Have you been told about Wissembly? There's various signs up anyway if you haven't. So do get engaged with Wissembly, because then we can do a different type of panel where basically you're all on the panel and we become the audience. So it's your chance to make your views known throughout the sessions. Questions and comments will be sent to me on this, so I've got an idea of the issues that are concerned to you, rather than me just communicating the issues of concern to myself. All you need to do is to tweet with the session's colour-coded hashtag. So in this case, it's #OECD red. OECD, the colour red, R-E-D, one word, one hashtag, and I will get it, and I can put some of those issues live and in real time to the panel. And we're just going to test that out now, okay? Make sure you're all listening with a sort of starter for 10. A question about banking, which I think is ready, which is, so you'll have to tweet your answer with hashtag OECD green, sorry, OECD red even. Here's your chance to vote. It's an anonymous thing, but we just want to hear from you. Do you trust your own bank? Send the keyword OECD red followed by the number 1 or 2. 1 for yes, 2 for no. We'll let that run whilst I introduce the panel. And I'm just going to ask a very quick question about where we are right now as each member of the panel is being introduced. So let's start with, just in the middle of the panel there is the Minister Bjarni Benediktsson. Forgive my Nordic pronunciation there. He's the Minister of Finance and Economic Affairs since last year of Iceland, and chairman of the Independence Party since 2009, and obviously is trying to help rebuild that country's financial system after a torrid few years. So let me just quickly say hello, Bjarni, and ask you, Minister, whether you're confident that your own banking system is now safer, and in general, whether the world banking system is any safer than at the peak of the crisis.
Thank you so much. Well, yes, I think definitely the banking sector in Iceland and in Europe, for that matter, is safer than it was before the crisis. Most definitely, we've been doing a lot of work on the regulatory side and cleaning up laws and regulations in as far as we can to make sure, not least, that the taxpayers are protected better than they were before. I think also the banks have revisited their business models, and in some cases, like in our case, we had a full collapse of the banking sector, and we rebuilt a new domestic banking sector, which is not as complicated, not as vast. It is isolated to the Icelandic economy and is most definitely a lot safer. It has very high equity ratios, has been capitalized pretty strongly. So it's safe, but I think we will never be able to build a set of rules and regulations that will fully protect us. And we have to always bear in mind that in the case of a financial collapse, there will be an economical disruption which may cost the government and hence the taxpayers.
Thank you, Minister. Thanks for keeping that. We're just going to keep these first answers to 2 or 3 minutes before we get into the debate proper. So, Diane Coyle is a visiting research fellow at Oxford University, runs a consultancy, Enlightenment Economics, is a pillar of the intelligent establishment of the United Kingdom, and has just written a great book called GDP. Diane, can the banks ever rebuild trust and get people saving again? Your quick answer in 2 or 3 minutes.
Well, I'm talking about the UK banks, and I don't see that all that much has changed, really. And obviously, the economy is growing more strongly. We saw in the OECD Outlook this week that the UK is doing quite well compared to some others. But the banks are still too big to fail. They're still very interconnected with each other. They are still decreasing their lending to business in the UK. Asset prices are rocketing, particularly housing prices, so mortgage lending is going up. And it's a bit like it's partly like it's 2006 in UK banking again. Not quite as excessive, of course, but I'm a little worried about it, and I'm not sure how safe they are.
Well, food for thought. We'll get more into that over the course of the next hour and a half. Okay, so next, John Hope Bryant, entrepreneur, author, advisor, and a recognised leader in empowerment in his home country of the United States. Originating from South Central LA. He's doing much praised, amazing stuff to increase access to finance and pioneer new forms of finance. Listen, just a quick question, John, about your country, about the US right now, as you see it. Has, if you like, the deal between Wall Street and Main Street, is that in a better place than where we were and where we've been over the past decade?
Yes and no. The system is safer, but more at risk. It's safer fiscally. Higher capital ratios, et cetera, more transparency, regulators who are doing their job, CEOs who are more, if you want to call it, sober. But it's aspirationally more at risk because all the leaders are sort of digging in the wrong holes. They're looking for love in all the wrong places. We'll get into maybe in the Q&A, because I'll keep this quick, but where jobs really come from is not where you think. Where does GDP really come from? It's not where you think. Where is the future promise for, where's the future of banking? It's actually, well, I'll save the answer for later, but it's not where you think. Yeah. It is a system that is in its current structure really not sustainable. I'll give you one quick example. In America, we have credit scores. The joke is not so funny amongst many bankers is unless you have an 800 credit score, and by the way, 700 is like near perfect, unless you have an 800 credit score and a 30% down payment, you aren't getting a loan to become a homeowner. There was a CEO I was talking to recently. He was saying that his bankers came to him with great pride to report that the average credit score for a auto loan was 788. And he said, they were like gloating. He said, why are you gloating? You can't qualify for the loan that you're underwriting. The bankers couldn't qualify for the very loan that they were turning somebody else down for because their credit score wasn't 788. But they were taking great pride in the fact that they had raised the bar so high that they had wrung so much risk out of it that you had no opportunity and no aspiration. So we got to find this balance because basically all job growth comes from small business owners, startups, shoot-ups, and entrepreneurs, and they are not getting access to capital, and the banks need them to grow and need them to prosper. We're basically lending money to people who can prove they don't need it.
Well, that's a great way to start. A trailer for the main event from John in a few minutes' time. Okay, let's go on to Guillermo de la Dehesa, who is the chairman of the Centre for Economic Policy Research, which you'll all know is a brilliant network of academic economists across Europe, publishing the very highly influential and incredibly successful Vox EU blog, from which I basically steal all my opinions. So I thank you, Guillermo, so much for everything. But let us know, do you recommend that capital market... No, well, let's park that question for a minute. right now in Europe, there's a big debate, isn't there, about the European Central Bank. This is the thing. This is a terror facing everybody. The European Central Bank getting its abacus out and measuring all of Europe's banks, see whether they're safe or not. Are we right to be scared about that? How big a shadow is the ECB's? It's the AQR, isn't it? Is that casting over the future of Europe's banks?
Well, I think that it's not going to affect much.
Oh.
No, I don't think so. Most banks in Europe have already been doing their homework, and the stress test is tough. AQR is, I think that most banks will go through, and then the stress test is not really very tough, but enough to prove that the banks are okay. And so I think that maybe the stress test will leave a few banks behind.
So some will fall?
Yes,
Okay.
that will not pass, maybe a few.
Okay.
But as you know, only 130 banks are going to go through this process. And the ECB produces every year the number of credit institutions in Europe, and there are more than 6,000. Germany has 1,600 only. So only 130 of all these really go through the test because they are larger. So Spain puts more, for instance, I'm from Spain, puts more number of banks than Germany and other countries because they are bigger after the banking crisis.
Okay, great. Thanks for that. Okay, just lastly on our introductions, we have Dennis Snower, who's president of the Kiel Institute for the World Economy and a professor of economics at Kiel University and sits on a number of important economic councils. Dennis, I guess the one question that's raised most readily in the media in this debate is about bonuses and compensation. Has Europe has the OECD, frankly, come to any more sensible place on compensation right now?
I don't think that we've come to any sensible place on compensation. What's happened in that regard is that there's been huge amount of outrage in society at the high compensation that heads of large financial institutions receive, and politicians have found it worthwhile to cap it. And in some countries this has succeeded, in other countries less, and often can be avoided reasonably easily. At no point has the underlying issue been addressed. In banks that where compensation has been capped, they see that as a cost that the leaders of the banks have to bear because of the nasty press they've received and the public outrage. But there's no positive force driving us into the future. Now, two things have happened that we should be aware of that bear on this enormously. One is the way we've thought about compensation has been extremely individualistic and materialistic. We believe that people are driven mainly by selfish material motives. And economists have a principal agent model of banking that induces bankers' interests to align more or less with the shareholders' interests in order to keep them on the straight and narrow. That isn't the straight and narrow from a public point of view, because systemically relevant banks need to be rescued whenever they go belly up. And therefore, it's still possible to offload a lot of the cost of risk when there are severe negative shocks. But this alignment along completely materialistic and individualistic incentives is something that is at odds with what we know about human nature. And that is that people are not purely selfish and they're not purely materialistic. There are a lot of other motives that come into play, particularly when they interact with their in-groups. And we have not chosen to align the issue of incentives of managers with their responsibility within society. The second thing that's important to understand is that something has happened since 2008 that drives us in that direction. Before 2008, it was sufficient for bankers to maximize their profits. If that hurt society, then the government wasn't doing its job. Since then, it's no longer sufficient simply to live within the bounds of the law. But what has not happened is that this idea has not been inhabited by a vision that actually promotes social goals. And to bring bankers' compensation into some contact with a measure of care for society, in care defined in ways that they understand very well when they deal with their family, their community groups, their religious groups, that care needs to be expanded to the rest of society, that has certain implications for compensation systems that we have not resolved, even though we know that enterprises that offer performance-related pay induce very different levels of cooperation than enterprises where teams are rewarded and the rewards are shared equally. So that gives us food for thought.
Great, thanks. Lots of food for thought. I think, can we bring the poll up and just see what our first poll result is on whether we can trust the banks? Is that going to come up in a second? Oh, right, well, there we go. But that's a thumping majority for you don't trust your own bank. So obviously the obvious question is, why don't you change your banks then? But well, I can't ask you a question yet. In fact, no, answer me back on hashtag OECD Red, or if you voted for no, why don't you change your bank? Now, let's start, though, the serious discussion. Loads of food for thought there. I mean, it strikes me as a journalist that this is about, if you like, a social contract, and that banks pretty clearly failed their social contract. John, let's start with you. What would you do? I mean, can this contract between societies and the banking system, can it be saved?
I'm going to say at least two radical things. Number one, while I agree mostly with my friend Snower, Professor Snower, I'm going to track a slightly middle line to what he's saying. I found that most people hate rich people until they become one. And so I don't think that anybody begrudges somebody doing really well. I think that though, if it's a choice between getting rich and building wealth, that's a big difference. You want somebody, if somebody can build wealth, build as much as you can, and you should be rewarded for that. If all you're doing, though, is getting paid, and it's about me, myself, and I'm tired of talking about me, now you talk about me, then that's a problem. And I think that's what Professor Snorer was talking about. But I'm a capitalist with a heart, so let me make it very clear. I think that enlightened self-interest is actually a good thing in balance. Now let me go to your very good question. I do think that the relationship can be mended. I think that rainbows only follow storms. You cannot have a rainbow without a storm first. I think the world needed this crisis because people don't change in good times. Why would you? Why would anybody change in good times or when they're comfortable? They only change when they're uncomfortable. And every good marriage is made of constructive friction. So let's make this about constructive friction. Here's what I believe. I think that banking can only survive, it can only be saved by the working poor, the struggling class, and the struggling middle class. I think that without that group, the banking industry is, as we know it, is dead. What we're doing in America to address this, and we've opened 82 offices in 160 days with this philosophy, is we're creating a private banker for the working poor, the struggling class, and the struggling middle class. I want to actually commend OECD because it was 2 years ago when I came here and announced that Project 5117 as a dream, and now it's a reality. But what we're doing is putting hope inside of bank branches, as an example. There's 100,000 bank branches in America, but arguably, today, that's your bank branch. And when they start allowing me to deposit my check on a cell phone, I never walked into another bank branch. I don't know about you, but this is where I do all my banking. So the bank branches need a new mission in life. And community banking, returning them to community as I think that mission. So we put hope inside of bank branches. We do government-approved mortgage counseling. It would be a bond in the UK, I guess. We do certified consumer credit counseling. We do small business and entrepreneurship training and funding. The guy who made this suit, we put in business as an example. We do small business and entrepreneurship training, a bundling of government services. So if you qualify for something called the Earned Income Tax Credit in America, most of you won't know what that is, but basically it's a credit for working. And if you make $28,000 a year in America and you have 2 children, the government owes you $4,000 cash. But unless you have a tax planner, no one tells you that you qualify. And if you have never filed, it's retroactive for 3 years. That's $12,000. That's more money than you'd see at any one time in your natural-born life. We will qualify you for the EITC and open a bank account for you and wire that money to you. But most importantly, we're moving credit scores 120 points in 24 months. And nothing changes your life more than God or love than moving your credit score 120 points. So the average so-called poor neighborhood in America, but think any place you live, think about a check casher next to a payday loan lender, next to a rent-to-own store, next to a title lender, next to a liquor store. It doesn't matter where you are in the world, they exist. Some would call that racism. I don't. That's not racism. That's target marketing. And they're simply targeting a 500 credit score customer. And all I'm going to do is rob them of their customer. Because when you raise the credit score 120 points, you create, voila, a sustainable customer for the bank. So now a 550 credit score customer is a check cashing customer. A 670 credit score customer is an entry-level banking customer. So we're creating sustainable customers. The word sustainable is key. Sustainable customers for banks, bridging them to those who were not previously qualified. And we're finding that the banks, SunTrust banks in particular, one CEO walked in and he was expecting 100 people in 3 months to come in through his bank that was not there before because we were there. He called me. He said he had a 4X increase over what he projected. He had almost 500 people coming into his bank branch. A bank branch you could have shot a cannon through and not hit anybody before is now packed with people who actually like him. So I think that when you remove these credit scores community by community, you turn a poor neighborhood to an emerging market. When you do that, you pop the tax base. You pop the voter population because you don't vote unless you have a stake. You create sustainable customers for banks and corporations. You create GDP growth. You create higher financial IQ. And those people are more inclined to move into things like small business.
Just very quickly, John. I mean, wasn't part of the issue? No, this is not the question you think I'm going to ask. Okay, it wasn't part.
You're not predictable.
Wasn't part of the issue in the run-up to the crisis all around the world? Really, was the automation of banking, and the idea that everybody's rating or everybody's ability to repay their credit could be calculated from a series of equations and all that sort of stuff. Wasn't that a key part of the problem? And are you bringing back a more kind of human touch banking? Is that the essence of it, or are you just tweaking the existing model and making it just a bit more honest and a bit better?
So before I answer the question, let me say that I inferred in my last statement that all bankers are not evil. That was really the inference. That here's some banks that we're working with who are doing the right.
That should be the next poll question.
Who are actually doing. So if we're going to criticize them when they do bad, we've got to commend them when they do good. And this is a very important. This is leadership. You got to be fair. No, I don't agree that automation has been the problem. I think that greed and laziness has been the problem. That this has not been an economic crisis. It's been a crisis of virtues and values. That for 100 years, an entrepreneur has been obsessed with an idea. I mean, Ted Turner was obsessed with this 24-hour news thing. Before that, it was news at 5 and 11. Now, you go to your TV and you don't see 24-hour news, you think the TV's broken. But wealth was the byproduct of him having this great idea. The last 20 years, you ask anybody, why you want to be in business? I want to get paid. Why you want to be a professional athlete? I want to get paid. Why you want to be on Wall Street? I want to get paid. To Snower's point, everybody wants to get rich. When the byproduct becomes a product, it's only a matter of time before you hit a wall. You're literally rearranging the deck chairs in the Titanic. It's my view that this is a crisis of virtues and values, that the automation is no different than the internet. It's a new way to deliver what you're selling. But we're selling crap, you're going to end up with crap on the internet or crap on a phone. So don't tweet that. So,
It's
yeah.
going out live on the internet. Okay, well let's go from.
By the way, Africa will probably be the first wireless continent.
Yeah.
And they're going to do all this on a cell phone platform. And I've seen incredibly dignified and dignity-rich activities going on an automated phone. So I don't think that the technology is the issue. It's, again, it's lazy
Well,
capitalism.
it wasn't so much we'll come back to this, but the general point I was trying to point towards was that there is a sentiment around that if we got back to old-fashioned banking, where you knew your bank manager,
yes.
who knows you, who knows about relationships,
Yes.
and instead that relationship was replaced with a computer. And guess what? Those computers are really good at lending against property because you have security, but rubbish at lending to small businesses that create jobs.
So I'm a little slow on the uptake, so
Yeah.
it took me
Yeah.
about 20 minutes to get that. But yes, I agree 100%. It is high tech and high touch. It's not one or the other. It's both. You're not human doings, you're human beings. And ultimately, a credit score or computer is not going to be able to process your character.
Great. Okay, right. Let's go from future to maybe immediate past, where things did look not so great, did they, in Iceland a few years back? And you've said that things may be on the road to recovery, but they may never, things are never going to be perfectly sorted out. Tell us a few things that you've done in Iceland in the sort of rescue job. I mean, I suppose you came back into government a year ago, so some of this would have been enacted by your predecessor. But as a nation, tell us some of the things. I mean, some of the things that I would be interested in is there was extraordinary policy of writing off excessive mortgages for households, so household debt restructuring as well as for giant countries and for banks. There were policies around, obviously, I mean, capital controls is probably not something you'd advocate around the world, but that was seen as fairly extraordinary. Tell us about and you're commonly seen to have burnt the bondholders and made the big bankers pay as a nation.
That's true. I already heard the term here today, too big to fail. Well, we have 3 banks in Iceland. They are on the list of the 10 biggest bankruptcies in world's history, along with the Enrons and GM and Washington Mutual and Lehman Brothers and the others. So
3 banks from an island of 300,000.
A little over 300,000 people live in Iceland, and we had 3 banks. They had all vast international operations, and essentially they were far, far too big to be saved for the Icelandic government. There was no way that we could step in and nationalize or give guarantee for banks that had brought on borrowings that exceeded 10 times our GDP. So what we did was we saved the domestic banking system. And of course, we took assets from the old banks and we took liabilities from the old banks, and most importantly, the deposits. We gave deposits priority towards assets, and that also meant that deposits abroad had priority towards assets of the old failed banks. So I think this was a very successful program which we came up with late 2008, and a little over between 5-6 billion US were written off. And that's a lesson I think we need all to learn, is that creditors should also be liable in the case the bank runs into trouble. It shouldn't all be about saving the creditors. Of course, shareholders number 1, creditors number 2, and if that doesn't suffice, then all right, we will have to deal with it. And like I said earlier, it was evident that the taxpayers would pay, if not directly, then indirectly, and we certainly have paid, even though we did not save the banks with a guarantee or by nationalizing the banking system. We've paid indirectly. We had to take on loans to recapitalize one of the banks. The creditors also stepped in to recapitalize some of the new banks, two out of 3. We also ran huge deficits.
But the deal here was that in return for your bailout, or the Icelandic bailout of banks generally, or the system, those banks were fundamentally restructured. All of the bankers lost their jobs. You apply.
That's true. Yes,
that's true. Right.
Yeah,
Okay.
I mean, these are new banks, new entities. Yes, with new management, new shareholders, and they all had to be refinanced.
So there was like a purging and a cleansing in the Icelandic banking system
Mm-hmm.
that maybe you don't spot elsewhere around the world.
I think yes, and I think the rating agencies, which gave Icelandic banks the same rating as the U.S. Fed had at the moment, they could borrow money endlessly. They also have to take a blame, and they back their rating on their pre-assumption that the Icelandic state would always step in because some banks were too big to fail, and that they were simply wrong.
So just quickly, the other thing that I found very interesting about the Icelandic model, as they call it, is the two R's. There was a bit of redistribution in the bailout, i.e. some normal families got a bit of a bailout in terms of their debts, and there was also redistribution and retribution. You've got some guy in an office sort of jailing bankers as well, with a long list of kind of Judge Dredd figure. Mr. Hawkson. So tell us a bit about his job won't last forever. Tell us about redistribution and retribution. Does that help the purging process in terms of society's links to a banking system?
I think it was inevitable. I think it was a very important part of rebuilding the economy and getting resurrection. I mean, the voters demanded it also. I think it was an absolutely integral, important part of rebuilding the economy. And yes, there have been some prosecutions. Some would say less than they had hoped for. We haven't had many jailed, but there are indictments ongoing. I think with regards to households, one has to bear in mind that we have our own currency, the Icelandic krona, that it fell very dramatically. We even had to impose capital controls. And with household debt being indexed to inflation, we got an inflation surge, which led to many households being, over-indebted with their house mortgages. So programs have been introduced, both by the old and the new government, to deal with that debt situation so that we see private spending come up again, and that, give homeowners hope to continue paying off their mortgages. When your mortgage is 140–50% of the market value of your household and you're personally liable, bankruptcy seems to be the best way out. And I think the programs to start with didn't dig deep enough, but all in all, household indebtedness is coming down, and also business debt has been dealt with very, very systematically.
Thanks, Minister. So already kind of probably some intuitive, broader thoughts about how banking crisis could have been dealt with or could still be dealt with. I'll ask Guillermo in a moment about whether things like writing off household debt, does that have any, could you apply that in Spain? Could you apply that in Ireland? Are there other countries where that might be just? But I want to come to Diane first, just taking up the Minister's point about, if you like, a kind of cleansing, the opportunity being taken, perhaps because it had to be taken, to fundamentally restructure the banking system in Iceland. A small example, a large problem. Did the same thing happen in Britain? Has the opportunity, if it is a good idea, been lost forever?
Well, I think that model of splitting out good banks and bad banks, or something similar as has been done in Iceland, has proven its worth in other cases too. The other example that people know well is Sweden in the 1990s. And there too, there was a very short period of intense pain, but a healthy banking system that emerged out of it. And it's interesting, there are reports at the moment that Barclays is thinking about doing the same thing, creating its own kind of internal bad bank to try and give itself a clean sheet for its other operations now. So it's a long time after the crisis, but maybe not too late to do it. But I'd like, if I may, to go back to this point about old-fashioned banking and technology, because old-fashioned is partly the relationship, but it's also partly the function of banking. And the function really is to collect together people's savings and use those savings to fund productive investments. And in the UK, at least, that just hasn't been happening. Out of the stock of bank assets, 3% of the total is funding business, and it's declining still 6 years after the crisis. So banking's not fulfilling its most basic function. And I think the issue is partly that in that kind of function, it's not a very competitive industry. The big banks in the UK have a very large share of the consumer market and the business market. So they compete a lot in their investment banking activities, And that's been very innovative. That brought us the massive innovation in CDOs and all of that led us into the crisis in the first place. But in normal banking, old-fashioned banking, it's one of the very few industries where there has been almost no customer-serving innovation over the years. And I think it was Paul Volcker who said the last good innovation in banking was the ATM machine, which is a long time ago. And as John said, there's now an example in Kenya of mobile banking. People on very low incomes with no bank accounts have access to much better banking services than in the UK and many other OECD markets. And I think it's because that competitive pressure hasn't been there. There's been no successful, sustained new entry into UK retail banking or business banking for generations, Santander being the one exception because they bought an existing entity. I think the hope is that the new technologies will make this happen. And there are peer-to-peer lending examples and new entrants in retail lending as well, who are growing extremely quickly. And the question really is, are regulators aware that they need a different approach? Because the regulatory model is built on the assumption that all new entrants have to have the same business model as the old entrants. And these new entrants have got a very different business model. But if we want banking that's old-fashioned and serves business and serves customers, then this kind of technology-based new entry has to come in.
We're just going to do the whole panel first. Okay, well, we've had a couple of answers to my vaguely facetious question about why you didn't change your banks, guys, audience. And your answers were, I don't change because how can I know if the next bank is even more trustworthy, or even less trustworthy, I presume is what they mean. Exactly. So maybe the question should have been simply, do you trust banks generally? So not hugely positive about the banks in general. Guillermo, why don't you take up some of those points and do answer the point about whether a more radical, some of the banks got bailed out. Why weren't the people who were lent money at the top of the property market in the Eurozone, for example? Is that not a way that the banking system could show its support in bad times for the ordinary people that, in the end, prop them up in the bad times? That you could have sort of household debt restructuring. Is that feasible? Does that work anywhere else? Anything else you want to respond to there?
Well, I think that most of the banking failures in this last since 2008 were due to not a good corporate governance on the one side, and then not a good supervisor on the other. So if you put the two together, for instance, in your country it was both. What was doing the Central Bank of Iceland when with these mammoths and let them go? I don't know. So this is an issue. Both issues are extremely important. In the case of Spain, for instance, that we had a very big saving banks crisis. It was due to also corporate governance. The saving banks in Spain, because the saving banks, from 45, only left 12. No bank was affected, so only saving banks. And one bank that was affected was owned by a saving bank. So the issue is that saving banks did an incredible job in Spain of regional development for more than 2 centuries. They were established by private people, and some of them by the church and others. And they did extremely well for 2 centuries. And suddenly, in 1985, after a few years of, in Spain, coming back to democracy, after Franco and so on, then the political parties decided that in the boards of the foundations and on the boards of the saving banks, local, regional, and provincial politicians had to be represented, as well as the trade unions.
Wasn't there
and the organizations of industrialists?
There was a ballet dancer on one
Sorry?
board. A ballet dancer on one board, wasn't there?
Yes.
A ballerina.
No, but all of them, yes.
Yes, there was.
But the issue is that since these people got into the boards, the saving banks started to do crazy things. And then eventually most of them went broke.
Now, this is really important, isn't it? Because we're, in
I
a
mean,
way,
this is key.
because we're saying kind of banks need to be more kind of reflect society and respond to society's needs. You're saying that there was a model kind of a bit like that in Spain where they got these, you know, what could be better than getting a trade union representative and a ballerina and others on the board to help.
No.
And it was a total failure and disaster, and the entire system has now collapsed.
Complete.
Right. Oh dear.
So,
Hang on. So we have a problem here.
well, but even more, you know, in the UK, the best corporate governance have been developed in the UK.
What?
The UK, the best companies and banks governance, the most advanced was in the UK. And in the UK, the banks also went bust.
Oh, only half of them.
Only half.
Don't exaggerate.
So I mean, it's something that is very very interesting.
So hang on. So well, if you're saying
And also the supervisor of banks, the worst supervisor of banks is always the government. And this is the case, by the way, of Germany, still today, and Austria and so on. They had a lot of failures. The second best is an independent agency, the FSA. But the best is always the central bank. So if you can look when the central bank is the supervisor, there are much less failures than if it is an independent agency, and even many less than if it is the government.
because it's sometimes a lot easier scientifically to identify the countries which are advanced, which didn't have a banking crisis, and think, well, what did they do, or what was their social structure? So we look at Canada quite a lot these days, especially coming from Britain, and we say, well, hang on, they had a conservative or a centre-right government that believed that prudential standards on the banking system were not a matter of right or left; they were just sensible. And guess what? They haven't paid a penny. Is there a lesson? Is there a lesson there? Is that lesson applicable elsewhere? I mean, maybe I should bring.
But let me
have a
say
quick
something
answer.
about
And
this.
then, yeah.
Is in the case of Canada is different because in Canada, each bank has a monopoly of the province, so they cannot compete.
Well, hang on.
Provinces.
Dan just said we needed more competition, and you're saying we need a monopoly. now.
Yes. Well, no. Is that they don't compete, and they are blocked in their own province, and the government, the central bank, did also a very good supervision.
But
Okay.
Canadian banks also have to get their charter renewed every 5 or 10 years, so
Yes.
there is some contestability. They get temporary monopolies.
Well, there we go. Okay, Dennis, let's just keep this vein of discussion going. Internationally, looking back on what we've been through over the past we say the past 5 years, but actually what you have to look back is 5 years before that, because the recipe was being cooked between 2001 2006. Is there any international example from your expertise of best practice in this area that we should follow as an OECD and as a world?
I don't at present believe that there's some example that we should just simply be following, but I would make the following point, and that is that it is very dangerous to look very simplistically at the different determinants of good banking practice. One could have many different segments of the population represented on a board, still leads to disaster. You could have different forms of competition, and it leads to disaster. What is relevant, I believe, are to a large degree the social norms by which people feel themselves to be bound when they conduct their general activities. So when we go through our daily lives, we have literally thousands of opportunities every day to steal from others, and that would be to our advantage, and we don't do it because we're constrained by certain norms. And that has a lot to say about how we feel as a society, but it has nothing to say about how important individualism versus communitarianism is, the issue that John brought up. When you consider the lot of the working poor, the struggling class, or the working struggling class, these are people for whom empowerment and financial empowerment in particular is terribly important in giving content to their lives. And what is it, I ask, that induces us or induces you to help create a system where this becomes possible? Well, it is a social responsibility. It is an adherence to certain social norms that are valid for society as a whole. Now, I believe if we could instill a stronger sense of social responsibility in that sense to people operating large financial institutions, then we wouldn't have to design a system that is foolproof with respect to every possible new financial innovation or shock that we could arise, because we could rely on people to a larger degree to do what is in the public interest. And we have managed to do that in the past. And I think one good example of this is 500 years ago in the West, many people approved of slavery. And since then, there's been a lot of literature that helps us identify with the plight of slaves. There have been social proximity that has allowed us to see ourselves as human beings and not cut across social groups in that way. And that has widened our circle of moral responsibility. And this widening of our circle of moral responsibility, I think, is required nowadays in order for us to take into account the plight of the working poor and the struggling class to a much larger degree than we've had before. And that is the sense, I believe, the sense of things that we should work on.
Isn't the basis, quick answer from the panel on this quick point, isn't the basis of much financial innovation and financial products that we see being sold to their customers? I mean, banking and financial services have been rather unique in that some huge proportion, particularly in Britain, but I'm sure across Europe, these products have been sold on the basis of a lack of knowledge on the customers, or one could say the assumption that their customers aren't clever enough to work out that they're being ripped off, which is an extraordinary way to treat your customers, really. I mean, am I unfair to point to that? I'm talking about things like, credit insurance that doesn't really pay out, mortgages that give you a very cheap interest rate for the first couple of years and then reset to like 10%, ensuring your potential bankruptcy.
I really think we're walking past, your point's an invalid point, but I think you're walking right past, I think the most important thing that's been said on this entire panel is what Professor Snower just said. I mean, that's the whole ball game. I mean, you can regulate people till the hills come home, but that's the whole ball game. Here's the problem in a sentence. Bill Clinton once said, it's hard to get somebody to agree to the truth when the lie is paying their paycheck. So this is about incentives and penalties. What are people incentivized to do, and how are people penalized? And if they don't think the penalties are going to be too heavy, and the incentives for being completely selfish are extraordinarily high, then it should come as no miracle that people are selling crap to responsible individuals and treating them like transactions and not as relationships. Now, my resolve to that, or my response to that, is to try to create an aspirational, to be for something that is sustainable versus just figuring out what I'm against. So what I'm trying to do is to create a what I will do is to create America's first national private banker for the working man. And I'll prove that it's profitable, I'll prove that it's sustainable, and I'll give bankers a reason to do well and do good too. They will make some money, and they will feel good they'll feel good about what they do. When they go home, they won't be a bum to their kids.
So there's a market solution. You don't necessarily, the hand of government in forcing good behavior is counterproductive, limited.
No, let's go one step further. So last week, I signed an agreement with the Consumer Financial Protection Bureau, probably the best thing that Obama has done in his administration, in my opinion, CFPB. We signed an agreement to be their outreach partner. Because here's what Cordray said, the director. I can want consumer protection all I want, but at 8 o'clock at night, when you're filling out a mortgage document that's this tall off the desk, and we're lying to ourselves to believe we understand what's in that pile of documents, there's no mortgage police. There's no consumer loan police. You've got to empower yourself to make better decisions when the police is not there. So consumer protection has to be partnered with consumer empowerment. It's not one or the other, it's both.
Dan.
Well, I agree with both John and Dennis, but I think you're wonderfully idealistic about it. And the trouble is that we have an existing banking industry where people live in a different moral universe from the one that you're talking about. And so I think as well as the positive examples and creating a different ethos of banking, there's going to need to be tough regulatory or government action as well. I mean, we've seen from the scale of the mis-selling scandals in the UK just how much of that mis-selling to customers went on. So I would start with the regulatory tools as well, just to create the space for the different kind of banking model.
Yes, so a quick response from Guillermo first, yeah.
No, I think that now it's impossible to go back to narrow banking. It is impossible because, as a matter of fact, this was a solution that tried to be made during the Great Depression, and it didn't fly up. And why? Because the crisis in 2008 was produced by shadow banking. So if you the only thing that you do properly went fine, but the shadow banking is the one that produced huge. Yeah. So if you go back now to the narrow banking, it doesn't help at all, because it was not the narrow banking. Yeah. It was the shadow banking. So if you now say, okay, all banks are very tiny and they do this only, then immediately all money will move to shadow banking. In shadow banking, central banks, you know, for them it's extremely difficult to find out what is going on in the shadow banking. And this is a very big.
There are mega European banks where they had board meetings where the retail bank would say we're totally covered for any fall in the housing market, we're very conservative, and at that board meeting they'd find out that their trading arm had bought a whole load of subprime, caja debt, cedulars, all this sort of stuff, and were basically the biggest lender into the retail market for people they had never met and would never meet in their entire lives at the same bank. And one arm would not know what the other arm was doing. I don't think enough people know all this stuff. I mean, how many people here understand what a shadow banking is? I mean, honestly. So probably about half. And you'd expect more. I mean, this is, you know, and London is pretty much the capital of the shadow banking. How many people in Britain appreciate that? Anyway, we'll move on. I'm going to take a little bit. Did you want a quick response?
A very quick response to what Diane said. I believe we should be conscious that it is totally impossible, not only for the bankers, but also for the consumers, to understand the products they're dealing with in banking, but also in our everyday lives. When I click I agree to a new app on my iPhone, I have no idea what I agree to. Once I tried, it was 75 pages, and on page 25, I was referred to another website that had another 75 pages. So it is actually basically impossible to understand what one is agreeing to. And that's true of banking, derivatives in particular. And we, as societies, do not have the moral outrage that goes with this. Bankers and many other organizations are exploiting the cognitive limitations of other people, and that must be brought under control. I'm
going to take a few comments from Wissambly. Some great comments in there. I'm just going to read them out, and maybe we can get some responses from the panel to these. There's also another poll that inspired by the panel. I don't know if it can come up yet. If it comes up, someone notify me if the new poll has come up yet. But anyway, let me read out some of the comments. Oh yes, the new poll is there. To quote an anonymous member of the panel, do you think bankers live in a different moral universe? Yes, 1, no, 2. So, interactively, a message on Wissambly. How can we increase the bank's corporate social responsibility? I guess the corollary was, should we? I mean, I sometimes think should we not accept the banks for the incentives that they have, and achieve the social aims elsewhere? Anyway, that question there: how can we increase the bank's corporate social responsibility? Secondly, why should taxpayers always pay for the failure of banks? Is it a bank's role to be socially responsible? Let's take those 3 points. And there's a whole load of other things from Bax to Jepcot, what that was. So social responsibility, is it actually the bank's role to be socially responsible, or are we mixing things up in ways that will be problematic? Who wants to take that? Let's have a couple of views on that. Guillermo.
Well, the taxpayers sometimes don't pay. Look at the US. They reacted extremely fast. In 1 month, they introduced TARP. They bought all the bad assets. The next month, they obliged the banks to take preferred shares, government own preferred shares. And now they sold the TARP at a profit and the preferred shares at a profit. So the taxpayer in the US didn't pay for that.
There's other incidental costs. There's opportunity costs. Surely,
very small.
there's funding
Most
costs.
of it.
Do you agree with that?
Most of it was already without the taxpayer.
He's technically correct, but I want to go. It was profitable for the government. But let me go to the question about corporate social responsibility and whether that is the bank's responsibility. Absolutely. If you're FDIC insured, you're quasi-government. I mean, people basically don't care what bank they go to. Bank of Whoosy What's, Bank of Moo Moo Moo. If you're FDIC insured, it's here's my money. So when bankers complain to me about the regulation and this and that, I say, no, it's okay. No, I understand your pain. Just release your FDIC insurance and hang your shingle up and see how well you do. And no, I'm just kidding. So if you are guaranteed by the full faith and credit of the United States government, you bet your bottom dollar you have a responsibility. But I would say it's not corporate social responsibility, it's corporate business responsibility. And that's a sustainability message that I argued earlier, that it's you can do well and do good. But here's something I want to put as a teaser for all the people listening. In 1865, right after slavery, you mentioned Snower slavery, right after Emancipation Proclamation, President Lincoln, people don't know this, the first thing he did was sign the Freedmen's Bureau Act, create the Freedmen's Bank. The Freedmen's Bank's mission was to teach free slaves about money. He thought the most important thing he could do to set people free was to teach them the language of money. Because you cannot have freedom without self-determination. He promised them 40 acres and a mule because they basically built the country for free. They promised them access to this bank and a bank account and to teach them the memo, give them the memo on how free enterprise worked. He was killed 2 weeks later. The bank failed. But it is instructive that arguably the best president that America ever had.
But look, just taking Dennis's points, and we'll bring the minister in a second. I mean, Dennis is arguing that some of these products are just too complicated. Is that not that there is a role for the regulator at that point to say
yes,
you just can't sell that. You're not allowed to sell.
You and I can get a reverse mortgage or a negative amortization mortgage, and we're fine. We've got some stock options. We got some this. Our tax planner says, well, you do. You're a rich guy, but the policeman. Or the postal worker who's got a static, stable income, the mortgage like that in his or her hand is a time bomb. Yeah. They should not be allowed to give that mortgage to that person. That's what happened in the mortgage crisis. They manufactured customers.
Yeah. You're itching to get in, Minister.
Well, we had similar type of lending in Iceland before the crisis. The most common way to borrow against a new car was to take foreign currency loan because interest rates were too high on the Icelandic krona.
Beautiful.
So you were enjoying the low interest rates for the euro or the Swiss franc or even Japanese yen.
And you take on the currency risk.
And the lenders took on the currency risk, and it could have been the postal officer or anybody who had, for the time being and for the foreseeable future, all of his income in Icelandic kronas. So at the time of the collapse, they were in deep trouble, and it took years to fix that. That's not very responsible lending, and absolutely, I do think they should be socially responsible. And the good thing is that it's becoming good business to be socially responsible. You see more and more businesses realizing that. You know, PepsiCo had a big conference in Iceland not many weeks ago, especially on that. And we've seen more and more companies, you know, Whole Foods in the US and more talking about social responsibility and how that is good business. And that also applies for the banking sector.
Yeah, I mean, I go back to some of the things, some of the legal investigations we've had in Britain about complicated stuff where you're selling to another banker like LIBOR. And, you know, and the internal emails that we now have been revealed are extraordinary about the level of impunity with which some small section of bankers acted. But to a degree, I was thinking, well, it's with another banker, you know, they're all. It's kind of shark eat giant squid. They can. Sorry, I wasn't talking about a specific bank there. You know, they can fight each other to rule the oceans. But if they're fighting the little guy, then that's a problem. And you just dread to think what the internal emails at some of the banks were as regards a very complicated loan sold to a little guy. I mean, I assume they just will never let that come out. But I mean, I can't even believe those emails must exist. The equivalent of the LIBOR emails for interest rate swaps, for insurance on loans that turned out to be no such thing. I mean, so we talk about social responsibility, but do we even have a handle on the Do we just? I mean, am I going over the top about the irresponsibility? Should we just forget about that? I mean, do you feel
I think customer protection law definitely works against some of the terms that are being applied, like the terms that we just heard described, you know, 50-some pages or more, or 100 pages, you know, that could, you know, not be passed in before the courts. But that can be costly for the customer to bring it to that state.
Right, so we get to political economy here. Now, you're from a centre-right party, and isn't the issue here that if a bunch of consumer protection lobbyists had come up to you 10 years ago, I'll give you a time machine, and said, don't let these guys take out mortgages in euros because they're going to be destroyed in 10 years' time when the great crisis happens, you would have thought, well, honestly, I'd imagine that you'd have thought, no, this is an interference with our great free market companies. We should let them experiment. If they fail, their share price will go down.
And I think you're right. I think a lot of the customers who, afterwards said that, well, we didn't realize the risk we were taking on, really did realize, and they were taking advantage of the low interest rates in buying a bigger car or a new Jeep or, even a snowmobile or whatever it was. Some of them were doing exactly. Yeah, I mean, some of them were doing that, and they should. And if we don't keep people responsible for their own actions, then nobody is ever going to learn anything. But I think there are limits, and for example, in the case of mortgages, when you're buying for your own home, for your family, I think certain restrictions should apply.
So that's interesting. Definitely. So moral hazard, right? We hear a lot about bankers, but a couple of comments have hinted at the idea of, does moral hazard extend into the households? Yeah, it does. Sure. Right, but should you then let deposit insurance be should you let a little bit of risk be retained with a householder on their deposits, just maybe 5%, 10%? I mean, there are some
they are feeling the risk as their house is underwater. Their house is underwater. There, but I mean, look, we have people in America, people I know, who bought a house like you buy a toaster at Sears department store by asking, what's the payment?
Yes.
Everybody got paymentized. Yeah. What's the payment? Yeah. You never ask what a payment is when there's an interest rate attached. Yeah. And you don't do it with a six-figure 30-year asset. People did that all the time. So again, it's easy to dump on bankers. There's a lot of bankers who deserve to be dumped on. But there's enough responsibility to go around here. Everybody did a Madoff. Everybody wanted to participate in this buffet, and that goes back to values.
It's true that it was too good to be true and people shouldn't have fallen for it. But Daniel Kahneman has this saying, we don't think as much as we think we think. And we particularly are not very good at thinking about complicated financial products where there's a long time horizon and there's a great deal of uncertainty. And most people, including me, just don't think very well about those kinds of things. And so for almost all customers, I think they really do need to be protected against their own decision-making in buying any of these
That
products.
has profound impacts for kind of what we think of as a free market. Though. I mean, you're a senior economist, and you're saying that the informational constraints on this type of deal are so acute that someone, a regulator or a government or some other friendly guy, should come in and stop that contract.
I don't think it constrains the market. I think it sets the terms on which you allow people to sell financial products to customers. And very much as John was saying, if you want to engage in the market directly with individual customers who are not very sophisticated at all about these decisions, then you do it on much more restrictive terms than if you're a shadow banker and you want to play the computer games that you were describing.
I'm sorry. My friend here, my friend Diane, she's going to hate me a little bit. I really disagree with just one thing she said, that people need to be protected from their own decision making. I think I heard that. I put chills down my spine. Look, in I don't know, whatever the year the automobile was created, you know, people were on horse and buggies. Nobody knew how to drive a car, and people were like wrecking them at like 10 miles an hour, like, and today you have people driving on on expressways, you know, with their eyes closed at 120, going around, you know, the Autobahn. I just think that I call me an optimist. I do believe in the human spirit. I do believe we can get this. I think we never got the memo, ever. We never got the memo on how free enterprise and capitalism worked. It's not in schools.
John,
it's not in schools. Where is it taught?
Shocking statistics on the number of people that can actually calculate a percentage, for example. I mean, sorry.
Are you agreeing or disagreeing?
No. What I'm saying is you're assuming a certain base level of cognitive capacity.
I'm assuming you got common sense, and I'm assuming that you're in interest in your lives. But if it's what you don't know that you don't know this. You said that it's what you don't know that you don't know. No one's teaching it. How? Yeah. In a blind town, a one-eyed man's king. Who gave people this knowledge that we're supposed to now be pivoting off of?
Go on, Guillermo.
Okay, I'm done.
No, I agree. I agree with that. The original sin in banks is the following: is that governments have to protect depositors because they are the ones that vote. Yeah. The majority of the population. Number one. So by protecting depositors, then there are only two others: debt holders and two other stakeholders, the debt holders and the shareholders. But the shareholders are the ones that they command on the banks, because the shareholders are the ones that decide in the the AGM how much it needs to be paid, if they are doing that, if they should go into this or to that. These are made by the shareholders. The debt holders, on the contrary, don't have any help. But the fact that the government is insuring the deposits makes the shareholders to be more aggressive to take risk because the depositors are covered. So this is the original sin of the banks. So my experience is that the banks that have suffered the least are those where the major CEOs and so on, the ones that really take the big decisions, they risk all their net worth if the banks goes bad. This is the real issue.
Have you risked all
if they lose everything, they are very careful. If they don't, they are not.
Just Dennis, before we bring in the rest of the audience, you have some views, don't you, on the kind of how you begin to do some of this, and you change the risk structure, the equity structure of a bank.
There are 2 points I'd like to make very briefly. One is, so far we have assumed that people don't know all they need to know in order to insure themselves against risk. And the implicit assumption here is that most or all of our imperfect information is risk, that is something that's insurable against, rather than uncertainty, where we don't know the probabilities, we don't know what will happen. And I would suggest that most of the imperfect information we actually find in the financial sector is in the form of uncertainty. We have never had a financial crisis with the complex financial instruments that we had in the last financial before. Now, how do you calculate risk? Probabilities are calculated in the same way as you calculate with what probability you'll get a 2 when you roll a die. And the reason why you know that probability is you can repeat that experiment infinitely many times. But if there's something new, then it hasn't been repeated. It can't conceivably be repeated in any way, and therefore you're just up against uncertainty. Therefore, even if we had no cognitive limitations, we still couldn't insure ourselves against risk because they're not risks to be insured, it's uncertainty. There's one other point that I'd like to make, and that is that the most important reform of the financial system that we could have had, I don't think we have had in any country. And that is a reform that changes the underlying incentives of the large financial institutions to internalize the externality, make them pay for the risk that they generate.
Of going bust.
Yes,
Yeah.
and now one simple way of doing this would be to have mandatory contingent convertible bonds, which means that when a bank's capital ratio sinks beneath a certain level, so it threatens insolvency, its debt would automatically be translated into equity. And that would mean it couldn't go insolvent because there's no more, the debt disappears. And in addition, the shareholders' equity would be diluted. And the shareholders, anticipating this, would tell the managers of the bank, please don't generate the systemic risk because you're going to ruin my value. And that is something that would increase the costs of debt for the banks, and therefore they are dead against it. But it would clearly be in the public interest if it were done in an intelligent way. And although it has been implemented for a variety of banks in several different countries successfully, all successfully to my knowledge, it has never been implemented on a national mandatory level for all systemically relevant financial institutions. And that, I believe, reflects the very strong power of interest groups.
Great. If we can bring the poll up, actually, we can get the results. But I'm going to go to the audience now. Please raise your hands if you would like to ask a question. So there's a gentleman down. Well, why don't you just from the front to the back? There's two gentlemen on the front, on the third row. Gentleman there, and
The lady of the...
yeah, and a gentleman then, and then we'll go back. Yeah. So just take these two first. Yes. Yes.
Well, the problem with banks, as I see it, and have seen it for a long time, is that they do not act to the rules of a free market. You go to an auction room, the hammer comes down, whatever price you've agreed between the two parties that's it. You don't get your refrigerator or a car salesman coming back 3 years later and saying, I want more money. I've changed my business model and I'm in difficulties. You're going to have to pay me more. Yet for every financial product, everyone has to pay more if the bank is in trouble. If you create a free market where at the moment they sign the deal, that is the deal, they cannot change it, then most of the problems would completely disappear.
Okay. The next, we'll take a couple of points.
Hi, I work for the European Parliament's Economic and Monetary Affairs Committee. I'm not a politician, I'm a staff member, so I'll be cautious what I'm saying. We're in election times. The past 5 years have been extraordinary for legislators and regulators around the world tackling the crisis. I think in the European Parliament, we've passed alone in the area of economic and financial affairs about 68, 70 acts, legislative acts, including banking union, single supervisory mechanism, single resolution mechanism, dealing with deposit guarantee schemes and so on. I think there's a question actually to the whole panel. There's a maximum of issues which can be tackled by legislators and by regulators, and what can be tackled by other means. And I understand from John, for example, one approach would be more about financial education and actually teaching people to make the right decisions themselves, to assume responsibilities for themselves. Another approach I've heard from Professor Snow was about re-educating bankers or financial actors about their ethical behavior, but that's really long term. I mean, it took centuries to get away from slavery, and some would argue still exists today. So what are more short-term measures which could be introduced not by regulators or legislators, but in different approaches which are not government-led.
Oh, well, let's just take those two questions quickly. Who wants to pick those up? I don't think we can have everybody. We can't have everybody answering all the questions, but anyone want to pick up the point about? Yeah.
Well, I think one way of resolving this issue is to pay all the bonuses in shares to all the people that run the banks.
Weren't Lehman Brothers? Didn't that happen with Lehman?
Shares. No, Lehman Brothers was unbelievable. Lehman Brothers was like that. It was they were all owners, but the chief owner, Dick Ford, was not telling the truth to the others about what the risk he was taking. So it was incredible.
Okay.
This is why it went bust.
Okay.
Because it was a partnership, but the chief partner was hiding to the rest of the partners what was doing. So this is amazing.
Does anyone want to take the point from the gentleman here about free markets and it not being a free market, essentially?
Well, we know it's a highly subsidized market, and I think the general principle that if you want to live by the free market, you die by the free market too should stand, and that applies to bonuses as well. I would not allow any bonus structure that doesn't allow negative numbers in it.
Okay, right. Let's take some points from Wissambly. I'm still going to take some more points from over there. Is the post-crisis? Well, that's kind of quite similar to the one we just had. Okay, we've always talked about banks being too big to fail, but what about too big to jail? Should we prosecute risky behaviour? If so, how? You have some experience of that in Iceland. We have. How can banks... Oh, here's a key one. Okay, let's take these two. How can banks reconcile the need to recapitalise with the need to lend more in this recovery? So, who wants to take those? So, too big to jail? Well, you've explained what happened. It wasn't an easy process, was it? This kind of...
No, it never is. With any, prosecutions at all, or investigations for that matter. But we've spent a lot of money into doing the necessary investigations. And we've taken a few years to do so. And of course, it has to be built on the legislative framework that was in place. And it seems to be sufficient to deal with it. And so the question is, just as is in any other matter where the law is being broken, just have the system work. So but I don't think you need to go about it in a special manner when it comes to banking or the financial sector.
But broadly speaking, your special prosecutor has very strong powers to go in and look at documents and loan records and all this sort of stuff, basically.
That's true, yes.
Of the type that I would say we haven't really seen in Britain, have we? It could be quite interesting.
Well,
perhaps we should borrow him when you finish with him.
Well, you're free to have him. It's been costly. It's been costly, and we, of course, at some point you have to move forward. But what we need to do, what I said was, we built on the legislative framework that was in place, but we also had to set up the special prosecutor and give him the investigative powers that were needed to dig into this pile of mess. Yeah, I mean, it was huge, and it has taken until now, and we still have ongoing investigations. Okay. And it's 2014. This happened in 2008.
Yeah. Too big to jail? Anyone else want to quickly come in on that? Okay. How about the point about higher capital standards versus actually needing to lend money into the economy?
The issue is that, of course, banks, unlike normal companies, non-financial companies, 90% is debt and 10% capital. Banks. The normal non-financial companies, the maximum debt is 40%, the average. So banks have a much higher debt than non-banks. So this is so the only way to try to avoid have more problems is to increase capital and increase capital. But if you do that, then in the recovery of the Eurozone, for instance, as they all are increasing capital, they are reducing the stock of loans.
However, banks are not lending very much money for investment anyway. Most investment, at least in the UK and US, is funded from retained corporate earnings. Yeah. So I don't know how much difference it would actually make to the growth rate.
So that's true. So you're basically saying that the banking system, for all that we have had to stand behind it as taxpayers, does not actually, I mean, this is quite fundamental, does not actually allocate capital to the fast-growing parts of the economy that will create the jobs, that create the growth that was perhaps the whole actual core reason that taxpayers had to stand behind and bail them out.
Well, the UK figures are the ones I know, and net lending to business has been declining since the onset of the financial crisis. So it's not just that they're not lending more, they're lending less over time. And any new businesses are raising money from venture capital and other means.
Just quickly on this, John, you've got some views, haven't you, on
No, I was
this?
going to just say that the facts, there's some facts that nobody seems to know or recognize. For instance, for the first time in our lifetime, small business deaths have outpaced small business starts. This goes to your point in the U.S. So you have today 400,000 small business starts a year, give or take, and you got 500,000 small business deaths. That's the first ever. I mean, in our lifetime. And the key to any growth of any economy is startups, small business and entrepreneurs. Here's a quick factoid on the U.S. There's 27 million businesses. 6 million of them create one job or more. Out of that, less than 1,000 create more than 10,000, employ more than 10,000 people. Half of all employment is 100 employees or less. 70% of all employment is 500 employees or less. We're literally digging in the wrong hole. But the incentives have to be aligned. You've got to, when you restructure this system, you've got to not just restructure the risk model, you got to restructure the incentives model so that banks are incentivized to point their guns toward the thing that's going to drive GDP growth and, by the way, jobs. So I think that
So you know, we had this crisis. We had a broken banking system that was dysfunctional. But now, even when it's sort of off its knees again, it's not actually doing the job for which we want to provide support. I mean, it's not a great.
and they're structurally not doing the job.
Yeah.
They are structurally not doing the job.
Just let's take 3 or 4 more points before we wrap up. Sorry, just gentlemen there. There were a couple of people and the lady just here.
Thank you.
Yes, please.
Yeah. Your approach has been to analyze the system from a national point of view, but banks are multinational companies. And when you look at the conflict of interest that banks can have in terms of being related to particular officials in certain governments, and how would you fight that conflict of interest when they finance whole political campaigns of people that get elected? The second point is being multinationals, how would you go into the illicit financial flows that banks do create? For example, in my country, Mexico, there's an inflow of around $30 billion a year that comes in from North America into the banking system for drug lords, for example. And that creates huge amounts of problems. How can we regulate that? How could we go into that? Because that really goes into social responsibility.
Question just here. Sorry, I've now lost. Yes, just lady here. Yeah. And there was a couple more down here. On there. Yeah, please do.
So actually, I have 2 questions. One is more philosophical. The second one is more mathematical. The first question is regarding the moral. You spoke about the moral and that this is a problem. And as an ex-banker, investment banker, I don't like when the bankers are blamed for all the sins and all the problems in the world. So, and I want to relate to the recent movie, like A Wolf from Wall Street, which actually reflected the problem of the society. Since like the majority of those who watch this movie, they want to be the same. And it means just we are going on the closed circle. Nothing is changing. So my question will be probably to Diane and to John and also to the rest. Just do you see any tools or do you see anything that can change this approach of the society of getting rich at any price? This is the first question. And the second one is regarding the Kenya, because I was working last year for the project regarding the microfinance and all the rest. And it's really amazing market. I can agree it's very well developed. But the problem is the loans that are provided to these underbanked society is at 7% per month. Does it make them really richer? That's a huge question that I was asking myself, even though the tools is amazing. And when you're saying, John, especially when you want to create, and I really admire your passion about this, but when you're saying that you want to create a private banker for the underbanked or for middle class, like lower than middle class, we would say, to my estimation, what will be the rate of the risk that the bankers will be taking?
Great. One quick point here, and then just there's a gentleman here. Just if you can be quite quick.
Yes,
Yeah.
I have a rather short question.
Yeah.
Professor Snower mentioned the importance of social norms, and I just wondered, during the crisis, the Geneva private bankers, for instance, who were largely influenced by Calvinist religion, or the Islamic banks, for that matter, how did they fare during this crisis?
Very interesting questions there at the end. Right, why don't you take? You've got like, strictly speaking, 30 seconds each, but I'll give you a minute each to just wrap up and respond to anything that you've just heard from there.
There are a couple of questions there about social norms, and of course it's very hard because you've got to get a lot of people to change at the same time to change them. But it does happen, and my sense is it's shifting. A more recent example is the attitudes to smoking, and when I was younger it was something that everybody did and you could do it indoors, and that's completely changed within the space of 20 years, so I think it can change quite quickly. I'll end on an optimistic note.
What interest rate are you charging, David? What interest rate are you charging?
Oh, I'm real cheap. There's a great question, by the way. I'm going to give you two crisp response. One is that I think Quincy Jones says it takes 20 years to change a culture. I think in the last 20 years we've made dumb sexy. We've dumbed down and celebrated it, and we've got to make smart sexy again. And I think that starts with kids. So I actually think the smartest, quickest money is the smartest, best money is to teach every child as a requirement a course in the language of money in school as a requirement. And you embed with that a course in values. I call it a course in dignity. So it'd be a two, course in dignity and course in financial dignity. And I think that in 20 years, you'd end up with different type of leadership. Let me now go to your question about, and by the way, in the US, our work was responsible for the first federal law, executive order making financial literacy federal policy in 2008. With regard to the private banker, so we'll ultimately have 8,000 locations, 1,000 of them within bank branches. It's actually cheaper. It's the cheapest deal you can get, because if you walk in at 550 credit score, you're going to pay 12% interest rate, 15% interest rate. But if we can get your credit score to 670 or to 700, God forbid 710, you're going to pay 6%, 4%. I would encourage you to go to Project 5117. Just Google it. Go to the website. Look at the testimonials for yourself of people who've moved their credit score 150 points. Their dignity comes up, their self-esteem comes up, their choices widen, their costs go down, their aspirations go up. It is really a remarkable story of the development of human capacity.
We're over time. Quickly, Guillermo, on the microcredit point.
Microfinance. I am involved with microfinance in Africa. The issue is extremely important, because if they go to the local lender of the village, it takes 4-digit interest rate, 4-digit. If it goes to a microfinance, it's only 3-digit. It's a huge step. Then if you go to the normal lender, then it's if there is a banking system, 2-digit. So the importance of the jump from the local lender traditional in the village to the microfinance is huge, advanced, huge.
Thanks,
already.
Minister, just quickly on the international factor here, we were talking about, I mean, you're well aware of the international interactions of this stuff. Has the international agenda really progressed? Just a quick 20-second answer on that. Has it really got any further? Because I hear it has got nowhere, basically.
Well,
yes or no?
Maybe not.
There we go. And then just lastly, just at that point on norms, Calvinism, the point just made just here, do you think, is there any evidence that financial institutions with different types of social norms have actually performed any differently?
Yes, there is. Islamic banks have not been as prone, but I think that relies more on how well they do relies more on people's motivations than on these types of characterizations. One last thing I'd like to say with regard to social norms is that we need to become more sensitive to what is socially outrageous. And one thing that we've touched on are conflicts of interest. When large firms finance election campaigns and put ads in papers so that the media and politics becomes complicit in designing a system that serves the rich, that is corruption, even if it's legal. And there should be social outrage, and so there's far too little of that. That type of social norm needs to be created to a much larger degree as well.
I'm going to cheat here and say that, and I'll do this in 10 seconds, I think banking should be an honorable profession. We should want people to be bankers again. We should return it to an honorable place. There are many banks in America that actually did not participate in the economic crisis. They're mostly regional banks. That went right through it and did the right thing and made profits and did well at the same time.
Thanks very much. Well, that was a great panel. I'll leave you with one little tiny story, which was that when a UK regulator, after the crisis, cleaning up the mess, went to India to persuade sceptical Indians to open up their market to British banks, it was met with kind of vague laughter. He was saying, "Oh, you must remember that we've now created new capital arrangements where if you lend to commercial property, you have to take on more capital. It's a great idea. We call it macro-prudential. It's the new buzzy thing. It's brilliant." And the Indian Reserve Bank governor said, "Yes, we do this already." And the guy from Britain said, "Really? When did you start doing that?" And he said, "Well, we never stopped doing it since you told us to do it in the days of the Raj. So what happened in Britain?" So, and that is actually a true story. So that I think that there's lots in that. Listen, that panel was fantastic. I just want to join everybody in thanking the panel. But please show your appreciation for the panel. I'm sorry if I couldn't get to you. And I hope Diana gets her Eurostar, which was why we were meant to finish 4 minutes ago. Thank you.
I'd like to invite everyone to head to Amphitheater Blue for the closing session, okay? It's starting now. Thank you.